Today I've got 14 financial quotes or maxims that guide my retirement. I thought it would be interesting to share with you. You can challenge me on those. Also, keep score yourself on these 14 and look at your financial plans for retirement. Do they incorporate all or a portion of these 14? And what do you want to do about that if they don't? Maybe you're just fine with it. So these guide my retirement. Again, score yourself. I tried to put these in some order, but it's not perfect. Number one, be fearful when others are greedy and greedy when others are fearful. This is attributed to Warren Buffett. And I think everybody knows what this means. If everybody believes the stock market can only go up and, valuations don't matter and this is just a great time, it's a bull market for as far as we can see, then be a little cautious, okay? And when everybody is panicking, saying, don't buy anything, stocks are going to zero, that may be the time to buy. A lot of millionaires are made in those times. Pretty common quote. I think you get that. Number two, this time is different. This is probably the phrase that echoes around in my brain more than any other. This time is different. It's attributed to Reinhardt and Rogoff from a book, This Time is Different. When I hear that Apple PE ratios are 30 and, historical long-term PE ratios are around 15, maybe this time is different. This is innovation. Does innovation in blockchain technology and AI change things, and valuations are going to change? And this is just being driven and inside my head. I need it tattooed on my forearm. This time is different. Bites me. It has bitten me a few times. One, when the great financial crisis, 2008, man, that was ugly to go through. Now that you know the conclusion, know that it was ugly to go through, but it corrected. But the whole financial system looked like it had a high probability of collapsing. Also, COVID. That was a scary one. Now I was a little more seasoned, a little more wise, and I didn't take any action. I knew we were going to get through that, but it did feel like this time is different. Always keep that in mind. That should have been number one, I think. Number three, time in the market beats timing the market. It's unknown, but it's in Boglehead circles. That's regularly talked about. Can you hear my cicadas? They're out of the 7-year cycle. I don't know what's going on with these. Got a couple of them in my yard, but it's freaking 78 or 70 degrees here outside, and I wanted to make an outside video. I think you understand timing the market. I've got a friend that does this. He bounces between 100% the S&P 500 and 100% in a money market fund, and it's not working out. I just keep investing and keep my head low, prepare for a down market, and just let the market's history of increasing pay me. That's it. So trying to time the market's a loser's game because you have to do it twice. You have to time when to get out at the right time and when to get back in at the right time. We've all seen those charts around like, hey, if you miss the top 10 days of the S&P 500 in growth in the last 10 years, your returns are down like 30%. So you got to be in all the time. Time in the market beats timing the market. Number four, another one that occupies a lot of headspace for me is reversion to the mean. Jack Bogle talked about this, or John Bogle, sorry. The last 50 years, the PE ratio has been around 20 for the S&P 500. Okay. And if you go back to 1900, the PE ratio has been around 15. Well, currently the S&P is at 27. Like 50% higher. If you just look at the Magnificent Seven, You know, they're near 30, with Apple being at 30, Amazon being at 35, Meta being at 27, just to name a couple. Reversion to the mean is a real thing, and there's going to be a correction. My prediction: there's got to be a correction to what's going on right now, and I don't know if that it's not necessarily a bad thing. It's a feature of the market. Bear markets, market corrections, a feature of the market. Be prepared. Number 5, valuations matter. Benjamin Graham had that quote, and that means, I look at PE ratio as the most common thing people look at is, hey, if stock has a PE ratio of 40, that matters when you're looking at future returns. High probability you're going to have some reversion to the mean. It's not going to be quite as great. This time's not going to be different. You see how all these kind of work together? 6, bonds are safe, and that's with a question mark. Everybody remembers 2022. Bonds act inversely to interest rates. So when interest rates are near zero, which way do you think interest rates are going to go? They're going to go up. Some trigger, like COVID, is going to trigger those to go up and going to make bonds greater. So we all experience that. But also long-term bonds, if they're not keeping up with inflation, your nest egg is just getting eaten away. So I don't really see bonds as a great part of my, it's got a role in my portfolio, but I don't look for great returns. It's a short-term play for me. It's in my bucket 1. I have about 5 years of expenses in bonds. I got about another 5 years in a money market fund. I'm not a bond fan, and because I don't think they're safe. Now, the reason I have 5 years of bonds right now is because interest rates, while they're not historically high, a lot of indication that they're going to lower interest rates. So in 2024, early January 2024, I bought them after the Fed raised up the interest rates and expecting it to come down. So that's what I did and why I own some bonds right now. But long-term and short-term, I have concerns with bonds. Number 7, don't chase returns. What's hot now may not be hot tomorrow. The Magnificent Seven, you just look at those and they can only go up. Technology's here to stay. But they've got a lot of profits and a lot of growth built in over the next 10, 15, 20 years that would be extremely unusual, okay? Not saying it hasn't happened before, but extremely unusual. When I think about chasing returns, I think of the investment quilt. You probably have seen that. It's a patchwork of different colors of different investments. If you've never seen it, just type in investment quilt. Like the quilt that you throw on a bed. It tracks, year by year, like in 2025, what's leading emerging markets, fixed, small cap, REITs, international, large cap, mid cap, what's leading, and what happens is year to year, it typically changes. The number 1 this year may be number 7, maybe number 2. It's a patchwork, and that's why diversification really is a key inside of retirement. More on that. Be careful chasing returns. Again, these are guideposts for me. Number 8, dividends are free money. And that's another question mark. It's a common, and this is emotional for some people, but it's a common investor misconception. When dividends are paid out, that's not free money. It actually lowers the stock price when that happens. Now, I'm not saying these companies are good or bad. I'm saying it's not free money. Okay. Sometimes I like companies that would take that money instead of passing it out in a dividend to invest in ventures that can pay 15, 20, 25% return on them, or lock down the future a little bit better than pay it out in an actual dividend. I manage my investments by total return. don't even pay attention to dividends, although I love them. Okay. Number 9, far more money has been lost preparing for a crash than in the crash themselves. Again, this is a very similar quote to timing the market. Hey, I know people that pulled out of the stock market in 2018 because valuations were too high and, it's got to go back to the mean. Well, I don't try to play that game. You've got to time it twice, like I said before, in when to get out and when to get back in. So just stay always invested is what I do. Peter Lynch, that was that quote. Number 10, only when the tide goes out do you discover who's been swimming naked. Very graphic Warren Buffett quote. This reminds me of the Boy Scout motto, and I was a Boy Scout for several years, be prepared. You only have that friend. Remember that friend that talks to you about how much money they made in Apple and Nvidia? They only talk, you only hear from the winners. The winners are the ones that talk. And then when, those go down 40, 50%, they don't talk. So be prepared. Be prepared for the down market that's going to come. Bear markets are a feature of the stock market. Always remember that. I ought to claim that quote for myself. Bear markets are a feature of the market. 11, risk comes from not knowing what you're doing. Warren Buffett. Okay. Now, not everybody spends an enormous amount of time learning the stock market, learning about retirement, learning how to create a portfolio. What should they use in their models for rates of return, for inflation? How should they model expenses? What about one-time expenses? When should you take Social Security? Not everybody knows how to do that, but there are professionals available to you for free at Money Pickle. Second link below, free 45-minute call on your topic. If there's something about your plan you have a question on, or something you feel you feel good about your plan, you feel really good about it, but it's all been in your own head, get it validated by an external resource. Money Pickle's totally free to you. Totally free to you. You click the link. It takes you to a calendar. It says, what do you want to talk about? Set up the meeting for 5 o'clock next Tuesday to talk about when you should take Social Security. Here's my assets. You'll have this live discussion for 45 minutes. They are committed to answering your questions, earning your trust. And perhaps in the last 5 minutes of the conversation, they'll say, hey, do you see a future in this? I just dropped my clicker. Do you see a future? Do you want to continue this conversation? They're just going to do that in the last 5 minutes. Give them a call. Free. Did I say that? Number 12, past performance is no guarantee of future results. Warren Buffett. No, that's not Warren Buffett. That's an SEC required disclaimer. Sorry. History, what do we got besides history as a guide? What has happened in the past may not be perfect to what's going to happen in the future. But, there's a lot of overlap. Even innovation, innovation like AI. Well, how different is that? It is different, but it's not different this time. But when the computer was introduced, when the internet was introduced, what about when trains were introduced? Okay, electricity was introduced. The telephone. There's been innovation in the past, and I think we can learn from that. It's not going to be a perfect guide, but we can learn from that. Number 13, asset allocation is more important than stock selection. I don't have any individual stocks. Maybe in the future. I'm tempted at times, but have zero today. Roger Ibbotson and Gary Brinson study. That's who that quote is attributed to. But this is what percent of fixed and assets do you have, like money market funds, like cash, like CDs, treasuries, bonds? What percent of that do you have in percent in the stock market? Um, one, to keep you from, having dramatic losses. Number two, to buffer you during a downturn. You can pull from your fixed assets when the market is down, and you don't have to pull from your equities. When your equities are down, you're pulling a higher percentage. So like, I'll just explain that. If you got $1 million in your portfolio and you're following the 4% rule and taking out $40,000 a year, if you have a 50% drop in the stock market and you're pulling out the same $40,000, you're pulling out 8%, okay, which is a very high withdrawal rate, and could dramatically impact your longevity of your assets. Okay, last one is diversification is the only free lunch in investing. That's Harry Markowitz. It's why I have 17% international. In my equity portfolio, I have value in there. I have funds tracking value. I have funds tracking growth. I have funds targeting large, medium, small cap. Now, where I'm constantly looking at this and kind of grading myself is I don't have REITs and I don't have gold specifically. And, I'm following some conventional wisdom about gold. It doesn't make anything. I believe in the human spirit of innovation, and gold just doesn't fit. It is a hedge. Would have been smart this year. I think it's up 50%, but I don't have it. And I probably would have only had a 3 to 5% stake in that. But gold's pretty pricey right now. And I don't have REITs, real estate investment trust. Maybe I need to get some of that. REITs are pretty beaten down. Maybe it's a good value, but those are on my mind because I'm thinking, how can I diversify more? How can I diversify more through that guidepost? So, your action summary. You read these quotes. I got 14 of them. Does your plan reflect them as guideposts or bumpers for you? Do they lead you along your plan? What score did you get? Leave me a comment on what score you received. Do you need any help? Action number 2 is, do you need any help with this? You can get free help, free access to a certified financial planner. Okay, and I've talked with these guys from Money Pickle. Put in your question. What do you want to talk about? They're going to match you up with somebody that may be an expert on Social Security, an expert on creating a withdrawal plan, an expert on maybe it's an inherited IRA that's coming in and you don't know how to handle it, where to put it, how to invest it. What do you want to do? So give the folks at Money Pickle a call. It's free to you. Free to you. There you go. It's Joe out.